All right, let's talk about one of the most frustrating things in trading. Today, we're going to flip the script, going from prey to player. We're going to get into the real truth behind market traps.
So let me ask you this. Have you ever felt like the market is just hunting you? You know the feeling, right? You've put in the hours, you've found what looks like the perfect setup, you're feeling good. And then, boom, it just all falls apart. You start thinking, was I just unlucky? Is this whole thing rigged? It really feels like someone's out to get you.
So you're watching the chart, and it's playing out exactly like you thought it would. The price action is tech-stuck. You pull the trigger, you get in the trade, and everything is lining up perfectly.
And then, bam, out of absolutely nowhere, this insane spike just rips against you. It goes just far enough to tag your stop loss down to the exact tick. It's so precise, it's maddening. And just like that, you're out of the trade with a loss.
But here's the kicker. The second you're out, it violently reverses and takes off in the direction you knew it would go. It would have been a massive winner, but now you're just stuck on the sidelines, watching it happen without you. Sound familiar? Yeah, trust me, you are not alone. And this right here is the whole point. It's probably not that your analysis was bad. Nope. The real issue is a fundamental misunderstanding of how the market actually works under the hood. Seriously, once you see how these traps are set, it's going to change the way you look at a chart forever.
So who's actually pulling the strings here? Well, let's pull back the curtain and talk about the market makers.
Okay, first things first, let's get one thing straight. They're not a guy in a dark room hunting for your specific $100 trade. That's not what's happening. Market makers are huge institutions. Think big banks, hedge funds. Their main job is to provide liquidity and fill enormous orders for their clients. The key word here is enormous. The scale they operate on is what this is all about.
So think about it. If you have to buy or sell a massive amount of something without sending the price haywire against you, what's the one thing you absolutely need? Liquidity. That's it. That's the name of the game. For these big players, finding liquidity is literally everything.
So what is liquidity? Well, you can think of it like the bloodstream of the market. It's the pool of all the buy and sell orders out there, just waiting to be filled. And where does a lot of this liquidity come from? Well, it comes from us, from retail traders. It's your stop losses, it's your breakout entries, it's even those moments where you panic and sell. All those orders create a giant pool of liquidity. Okay, so now that we know what they're looking for, let's look at the game board itself and see how these traps are actually set. This is so cool because you can literally see where the liquidity is building up. Orders don't just spread out randomly. They cluster together in really predictable spots, like obvious swing highs and swing lows. And why there? Well, because that's exactly where everyone is taught to put their stop losses or to place their breakout entry orders. So these areas become giant magnets for price. And this is a super important distinction to make. You have to know the difference between a trap and a real move. A trap, or what we call a liquidity sweep or a stop hunt, has one purpose and one purpose only: to raid an area packed with orders, trigger them all, and use that fuel to push the price somewhere else, usually for a reversal. A real move, a break of structure, is totally different. That's signaling a genuine change in the market's direction. The intent behind the move is what matters. So if these big players are just hunting for predictable patterns, who's being so predictable? Well, yeah, it's us. We got to look in the mirror on this one, because the pattern starts with the retail trader. Look, we tend to be easy targets for a few simple reasons, right? We chase the levels that everyone on Twitter is talking about. We put our stop losses in the exact same place as everyone else, right above the high or right below the low. We get FOMO and jump in too late. We panic and jump out too early. They don't need a crystal ball to figure us out. They're just banking on us acting like humans. Okay, so enough doom and gloom about the problem. Let's get to the good stuff, the solution. It's time to learn a new playbook, one where we stop fighting the current and start trading with that institutional flow. It's actually a pretty simple 4-step process. 1, figure out the overall trend. 2, find a key point of interest, a supply or demand zone. 3, and this is the absolute game changer, find the pool of liquidity that's likely to get raided. And 4, you place your entry expecting that raid to happen. Let's walk through an example. Okay, step 1, identify the trend. Easy enough, right? We can see here the market is clearly heading down. We've got lower lows and lower highs, multiple breaks of structure to the downside. The big picture is bearish, so we should be looking for chances to sell. Step 2, find our point of interest, or POI. Since we're in a downtrend, we're looking for a supply zone. See this area here? This is where we expect a lot of sell orders to be waiting, where the big players might step back in if price comes back up to test it. All right, now this is the most important part, step 3. We don't just blindly set our sell order at that supply zone. No. We look right below it, and what do we see? A nice, clean swing high. That, my friends, is a liquidity pool. We can bet that anyone who tried to short this earlier has their stop losses sitting right above that high. So our whole idea is that the market is going to push up to grab those stops before it actually hits our zone and reverses.
And here we go, step 4. Look at that, the trap is sprung. Price pushes up, clears out all that liquidity sitting above the high, wiping out all the early sellers, and then it taps into our supply zone and reverses hard. That's our entry. By waiting for that trap, we didn't get caught in it. We used it to get an amazing entry riding right along with the big money.
You know, this is about more than just drawing lines on a chart. The real change here, the big one, happens in your head. It's about shifting your entire mindset. You stop being an emotional participant getting tossed around by the waves, and you become a patient observer waiting for the perfect moment. And if you remember one thing, let it be this. The market doesn't care about being fair. It's not its job. It's a machine for matching massive orders. Your job, your only job, is to not be emotional. As soon as you accept that these traps aren't personal, that they're just a normal part of how this machine works, they stop being scary. They actually become opportunities. So from now on, before you click that buy or sell button, just stop for a second. Look at the chart and ask yourself one simple question. Who benefits if all the retail traders enter right here? If a setup looks a little too good, a little too obvious, chances are you're looking at the bait. And asking that question, that's how you stop being the prey and you finally become the player.